Hi folks, this is Doc Severson for the TheoTrade video report for a Thursday, December 8th. We'll start out tonight by looking at the S&P 500 here, the SPX, and it's Groundhog Day again as we continued melting up. Okay, so this is not going to go forever. What we're going to get into is this kind of stair-stepping environment as we start to see the animal spirits overtaking Fed policy. Now, I think what's going to be really interesting to watch next week is as we get to our major Fed meeting. No surprise, they're probably going to raise rates, whether it's a quarter point or half point. I don't think the market is going to care either way. I think we have a market that's in a race to the end of the year. Now, what we're going to see is this sort of stair-stepping type of price behavior. We're going to see the market go as far as it possibly can on the initial thrust. Then we're going to see that move into more of a consolidation zone here like this, where it gets a breather. Then we get the next breakout from here and then back into another zone to take a breather. We're going to see this over and over and over again. So what we normally look for is just kind of the linearity of the trend. The more linear the trend, the more energy it takes to sustain that move to the upside. This is why we see it take a rest from time to time. Think about it. If you were to run up the side of a mountain, you wouldn't be able to do that for very far before you'd have to take a rest here, get a breather, then get a second wind, go as far as you can, then take a breather from there, run as far as you can, and then take a breather. So this is where we're going to come into with this, the fractal energy indicator that we have. Shows us essentially those areas where we expect the price to take a rest from here. And we're just about at the next level here. So we're just going to see this continuing to stair step higher. And actually this sort of price behavior I like a lot because it's a lot more predictive than it is during corrective price behavior. So this was essentially this whole 2 years in here, whereas the uncertainty of Fed policy. So the Fed turned on the spigots for QE3 around this area, and then they went into the taper around here. Remember the taper, right? So the taper was in this area, and uncertainty was the name of the game in this Fed era here. So there was no real growth going on. We were in an earnings recession during this time frame for 5 or 6 straight quarters it was. The entire market is just completely beholden to what the Fed is saying. And uncertainty reigned because even the Fed governors couldn't figure out what their story was in terms of raising rates, keeping it steady. Yellen saying that we were going to be in a high velocity market. So it's no wonder that there was all this uncertainty in here. And actually what we had was corrective price action. We had a few different serial corrections during this time frame. So that is in the rear view mirror at this point. And we've got what can only best be described as animal spirits overtaking the market once again. So how can you trade a market like this when it seems to be going up forever? Well, it doesn't go up forever. What we can use is a couple of tools here. First of all, the thing that we're going to find with every option chain is the expected move in here. So whether or not you have a broker like thinkorswim where the expected moves are identified on the right-hand side here based on the series that we're looking at, or you can simply add up the put and the call and do the expected move in the dirty manner by just going to the at the money straddle. So the at the money straddle is just basically going at the money, adding up the put and the call, and that's pretty close to what you're going to find for the expected move. So if we go out to this option symbol and this series as well, so for the SPX, we see that for 6 days from now, we have an expected move of about plus minus 29 points. We can go out to our chart here and let's zoom in a little bit. Okay, so what we saw was for December 14th. So let's mark December 14th on a time level here. So we have the 14th here, and we'll mark that right there. Okay, so we have that on the chart. And so for this price level here, we have about plus minus 29 points. So let's draw that in. So that's going to be anywhere from about 27.76. So let's put in a rectangle there, and we're going to go about 22.76 or so, which is going to be somewhere around here. and that's going to go down to about 18. Okay, so that's our target for 6 days from now. Well, if we're trading this with options, we can trade this any number of ways, right? If we use the random walk approach, we can basically say, well, let's set up a trade where this defines the range here at 1 standard deviation. So that could be something like an iron condor, double diagonal, any kind of other type of trade like that, which is more range bound. However, in a very directional market, what we can also do is make the assumption that when we have a trend that is this strong, that it's more than likely going to maintain some momentum and target the upper end of that. So this is one way that we can use this sort of expected move target to set up out of the money targets, which are going to give us a much better reward to risk. Here's an example of what one of these trades look like. Here's the initial cost of the trade. So you can see this is the maximum that they're risking on the trade. Here's the potential reward. So we're setting up this trade basically at the expected move target within around this area here and looking for the price to continue moving in this direction. And right now it's doing very, very well. In fact, if it goes just a little further into the end of the month, it'll do very, very well. So that's just the basic trade logic. Now, what could we do with a chart to be able to improve our probabilities on a trade like this? Well, for this, we go back to our S&P chart. And I've got the basic fractal time frames here, monthly, weekly, and daily. Now, if we look at all three of these, all we really want to know from these larger time frames is that we have essentially, think about this as a river, the current's flowing in this direction on both of these major time frames. And so from that, what we're looking for is an ideal entry point into that trend. And what we're going to do is we're going to identify these consolidation zones and areas where the S&P just sort of builds up energy and gets ready for the next move. And actually, we saw one of these just a couple of days ago, earlier this week, as the price was in consolidation, winding up the spring, getting ready for the next move here. And so this is our timing entry for these types of trades. So by using a little bit of random walk options theory as well as some basic physics here to understand how price moves, we can come up with better setups that really match the character of the animal spirits that we're seeing in today's price action. That's it for today's report. Thanks for listening, and see you this weekend.